Good evening, students. So today we are going to spend time on two chapters. Chapter 17, that is dispute resolution, and chapter number 18, which is miscellaneous provisions. Now, as you can see, first we'll discuss chapter 18. Before we get into the topic, there is one important announcement, and I will repeat this announcement towards the end of the session as well, those who are going to join little late. So the sessions which are scheduled on 19th and 24th of June, which is final paper 4, direct tax laws and international tax, they are now going to be rescheduled to 21st June and 28th June. So please note down the revised schedule, topic and time. On 21st June 2025, the topics to be discussed would be provisions to counteract unethical tax practices and tax audit and ethical compliances. The timings are 6 to 9 p.m. same. And second would be on 28th June 2025, that is Saturday, evening 6 to 9 p.m., non-resident taxation and double taxation relief. Now, these chapters will be taken up by CA Nikki Jamtani. So I repeat, the sessions have been rescheduled and the revised time is 21st June, Saturday, 6 to 9 p.m. And the topic to be discussed or revised would be provisions to counteract unethical tax practices and tax audit and ethical compliances. And on 28th June, again Saturday, evening 6 to 9 p.m., there would be non-resident taxation and double taxation relief. Now, these chapters will be taken up by faculty CA Nikki Jamtani. So, now let us discuss chapter 18 first, procedural sections. So what does this chapter contain? So we have already discussed this chapter a couple of months ago in detail. So now we are just going to revise the chapter, as the purpose of this session is to conduct a revision rather than to discuss each provision in detail. But yes, I think wherever you have got any kind of query or any confusion, please feel free to stop me. And if you have any case study or any kind of a question to discuss in detail, you can interrupt me anytime. So what is the content of chapter 18? So 269 SS, 269T, which deals with the prohibition on acceptance of loan deposit in any manner other than the prescribed mode. And it also deals with the repayment of loans and deposits. 269 ST, 269 SU, which deals with the mode of undertaking transaction and facility for accepting payment through prescribed electronic modes. 285B, which deals with statements, that is compliance requirement by certain producers of cinematographic films or persons who are engaged in the specified activity. 285BA, that is filing of SFT report. So those who have undergone their articleship, they would know that there is an SFT reporting requirement which was due on 31st of May, where the specified transactions are required to be reported in specified form. 285BB, annual information statement. So we all know that when we file the income tax return and we log into the income tax portal, we all look at Form 26AS, we look at AIS statement, which captures the information about financial transactions that have been entered into by the SSE during the entire financial years and which have been reported by the reporting persons with the income tax authority. We'll discuss section 281, which treats the transaction as void, which are undertaken to defraud the revenue. Section 281B, provisional attachment to protect the interest of the revenue. Section 282 to 284, which deals with the service of notice or communication. 282 capital A, authentication of notice in the prescribed manner. Section 292 BB, which treats the notice to be valid in certain situation, even if we have discussed this provision in a brief during our session a couple of days before, when we were discussing the chapter relating to assessment procedure, where we discussed that one case study, if you recollect, where if the department issues the notice and assessee has participated in the proceedings, and subsequently assessee cannot take a ground, if the assessment is completed, he cannot take a ground that the notice which was issued by the tax authority was not in accordance with the law, whether it was served late, not in time, or in an improper manner. Now, these kind of objections, if any, are to be raised before participating in the proceeding. So we'll discuss about this provision in detail, section 292 BB, and then there are certain miscellaneous provisions of procedural nature. So let us first, I think, we may discuss section 269 SS, and you all are, I think, familiar with this provision. I don't have to get into it in detail, because this provision carries a significant importance from the practical point of view also, because when you do the tax audit report specifically requires the reporting under in relation to the transactions which are in compliance with section 269 SS and 269 T. So what does this section says? Now let us read it line by line, because considering the importance of this section. 269 SS provides that no person shall take or accept any loan or deposit or specified sum from any other person, except by account by check, account by bank draft, or use of an electronic clearing system through a bank account or through the prescribed mode. So there is a restriction that you can't take a loan or a deposit otherwise than the modes which are prescribed. So to put it simply, the acceptance of loan or deposit should only be through the banking channels, whether it's a check, demand draft, or it is a online transfer. If you take through any other mode, then there are penal consequences. Now, this section is subject to certain further conditions. The section provides a threshold. What does it say? If the amount of loan or deposit or aggregate amount of loan, deposit, or of deposit of specified sum, number 2, or on the date of taking or accepting the loan, deposit, specified sum, any loan, deposit, or specified sum which was accepted earlier by the same person from the depositor is remaining unpaid or outstanding. The amount of such remaining unpaid, so we'll pause here, if it exceeds 20,000 or more. So the first condition says, if the amount of loan, transaction wise you have to see, if the amount of loan or deposit which is taken otherwise through a banking channel, let's say in cash, right? If you take it in cash and the amount transaction value exceeds 20,000 rupees, then you are violating section 269S. Second says, if on the date of taking the loan, the amount which was previously outstanding and the transaction value itself taken together, if it exceeds 20,000 rupees. And third, the amount or aggregate of the amount referred to in para 1 and para 2 exceeds 20,000 or more. So in all these cases, the transaction would be treated as violative of section 269 SS. Now there is a relaxation. For certain transaction, this limit of rupees 20,000 has been enhanced to INR 2 lakh rupees. So what are those situations? In case the deposit is accepted by a primary agricultural credit society or a primary cooperative agriculture and rural development bank. So it is only when the society is a primary agricultural credit society or primary cooperative agriculture and rural development bank, if it is taking it from its members. If they are taking from the outsiders, they do not have any kind of protection. If they are taking the money or a deposit from their member, then the limit is enhanced from 20,000 to 2 lakh. Second exception, if a loan is taken from a primary agriculture credit society or a primary cooperative agriculture and rural development bank by its member. So first is deposit is accepted by the society from the member, and second is loan is taken from a society by its member. So it is both way. Now, what is the rationale of doing this? Now, as we all know, these societies or a bank, they are primarily related to the agricultural activity. Now, agricultural income is exempt under Section 10. And second, the farmers are residing in a rural area where there may not be a banking facility, or their income is almost always in cash. So they sell their produce in cash, they receive cash, or in such a case, there are certain exceptions. We all know that 48 where the payment is 48 where the payment is in excess of 10,000 rupee in cash, there is a disallowance. But in that case, there is again a rule that gives an exception only for the farmers. So likewise, here also you have got an enhanced limit of 2 lakh rupees, and that 2 lakh rupees is applicable only in relation to this situation. Otherwise, there is a 20,000 limit. When is this section not applicable? If a loan deposit or a specified sum is taken or accepted from, or loan deposit is taken by the government, banking company, post office, saving bank, cooperative bank, corporation which is established by the central, state or provincial act, or any government company is defined under the Companies Act, any institution, association, body, class of institution, association, bodies with the central government in the notification specified. So these are the specified persons. That is government, bank, cooperative bank, farmers, they are all excluded from the purview of this section. Cases where the persons involved in the transaction, they derive income only from agriculture, or where neither of them has any income chargeable to tax under the Act. Now, this exception is also there, which is irrespective of a threshold. The only conditions are that the persons who are involved in the transaction, they derive income only from agriculture activity. So their sole source of income should be agricultural activity, and it is on both the side, receiver as well as payer side, and where neither of them has any income chargeable to tax under the Act. So their income should not be chargeable to tax under the Income Tax Act. In that case, they can undertake this transaction. Meaning of certain terms. What do we mean by loan deposit? What is specified sum? And prescribed modes. So these are the prescribed modes. As you can see, all these prescribed modes are nothing but the transactions which are undertaken through the banking channel. So what is left out is, number one, if you transact in crypto, if you transact in cash, so, or if you transact in a demand draft, which is not through an account pay transaction. So in all these cases, if you do the transaction, they are within the purview of 269 SS. What if we violate the provision? Then section 271 capital D says the amount of loan deposit or specified sum which you have taken, that would be deemed to be the amount of penalty to be imposed, that is under section 271B. Mode of undertaking transaction, section 269 ST. Before we discuss, let us briefly discuss section 269T, which is exactly, in relation to 269 SS, that is on repayment. And then we come to this section. 269 SS is about mode of acceptance of loan or deposit. 269T deals with mode of repayment of certain loans or deposit. What this section says? It says that no branch of the banking company, cooperative bank, or any other bank, any other company or cooperative society, or any firm or any person shall repay any loan deposit which is made with it, or any specified advance which is received by it, otherwise than by an account paid check or account paid draft drawn in the name of person who has made the loan or deposit paid by the specified bank. So no branch of a banking company, cooperative bank, or any other company or cooperative society. So far as 269T is concerned, even these are also covered. We saw in 269 SS an exception for some of them. So they are also covered. And if they are making the repayment of loan or deposit, otherwise through an account pay check, then let's see what is the consequence. So again, we saw there are three limbs to that 269 SS. Likewise, in 269C, 269T, it says if the amount of loan, deposit, or specified advance, together with interest, if any payable thereon, or the aggregate amount of such loans or deposit held by such person with the branch of the banking company or cooperative bank. Third, the aggregate amount of the specified advance received by such person, either in his own name or jointly with any other person on the date of such repayment, together with interest, if it exceeds 20,000 or more. Then again, there is a higher limit of 2 lakh rupees in case the deposit is paid by an primary agricultural credit society or a primary cooperative agriculture and rural development bank, or if it is repaid to a primary agricultural credit society or a primary cooperative agriculture and rural development bank by its member, right? Easy to understand. So likewise, in certain situations, the provision is not applicable. Where the repayment is made by a branch of a bank, cooperative bank, such repayment could be made by crediting the amount of loan to the saving bank account or current account, if any, with such a branch or a person to whom such loan has need to be repaid. Number 2, for the provision of this section again shall not apply in case the repayment of loan, deposit, or specified advance or taken from government, banking company, post office, corporation, any government company under 617 of the Companies Act, the revised section under Companies Act 2013, section 245, or the specified institution. So in these cases, section 269T shall not apply. Likewise, they have defined what is the meaning of loan or deposit or the specified advance. The penalty under section 270 capital E is imposed in case there is a violation of section 269P. So if there is a repayment through a mode which is not prescribed, then the amount of penalty shall be the amount repaid. So it is the equal amount. It is the transaction value that would be subject to penalty under section 271 capital E. Transfer to defraud revenue would be void. Now, what is the objective of this section? If you are facing the assessment proceedings or you are facing any kind of proceedings under the income tax law, and it is likely that there is going to be certain demand which is going to be raised by the tax officer. Now, if you undertake any kind of transfer of immovable property, movable property, or any valuable asset immediately before the proceedings, in that case, or during the specified time, which we'll see in the section, in that case, that transaction of transfer would be treated as void, as if it has not been entered into. And the only condition to invoke section 281 is that the purpose of transaction or the transfer was to defraud the revenue. If there is no element of fraud, or if the transaction is undertaken at an arm's length value or at a market rate, in that case, that transfer will not be treated as a void transfer. So let us see what are the conditions. The section says that as a safeguard against the non-realization of revenue due to fraudulent transferring of asset by an assessee using defraud, it is provided under the section that certain transfer will be deemed to be void for the income tax purpose. Therefore, when during the pendency of any proceeding under the Act, or even after completion of thereof, but before the service of notice by the TRO. So what it says, if during the pendency of any proceeding, so the proceeding should be pending as on the day on which you undertake a transfer. If there is no pending proceeding and you carry out a transfer, in that case, the section is not applicable. It is only when some proceedings have been initiated and you undertake a transfer. Or it also covers a situation where even if you do the transfer after completion of the proceeding, let's say the order is passed, but before the service of notice by the TRO, tax recovery officer. If you create any charge on the asset or part with the property by way of sell, mortgage, gift, exchange, or any other mode of transfer whatsoever of your assets in favor of any other person, then such a charge or transfer would be deemed as a void. So there's a deeming fiction. We won't consider that transfer at all under the Income Tax Act as against any claim in respect of tax, penalty, interest, fine payable by the assessee as a result of completion of proceeding or otherwise. So that transfer would be treated as void. Now, this provision is applicable to all the cases where the amount of tax or the sum of money which is payable exceeds 5,000. If now practically this materiality threshold, should have been kept, but they haven't changed the law and the limit is old only 5,000 rupees, and the assets which are charged or transferred by the assessee exceeds 10,000 in value. So see, the amount that has been described is quite insignificant. So we have to be extremely careful that when we are doing any kind of, facing any kind of assessment and there is likely to be a huge demand to be raised and assessee carries out any transfer during the pendency of proceeding, then the transfer will be deemed to be void. Now, the section also gives an exception to this rule. It says that we won't treat the transfer as a void where there is an adequate consideration. That means you have done a transaction for a consideration. It is not a case of a gift or an inadequate consideration. But it also says that, and without any notice of pendency of such proceeding. So let's say the proceedings have started, the notices have been issued, but you are not aware about the notices or any pendency of proceeding, and you have done the transaction and the ordinary course of, kind of a manner, and we have done it for adequate consideration. So two things are important. The transfer should be for a consideration should be adequate, and second, you should prove that you are not aware about pendency of proceeding. Second, or maybe without any notice of such tax or any money remaining payable by the assessee. So in this situation, the law says we are going to recognize your transfer, will not treat it as a void. Second, if the proceedings are going on, but you seek a permission from the assessing officer to undertake a transfer. So if you seek a permission, then probably there is not going to be any kind of challenge. Now the section also defines asset. Now, what is asset for the purpose of this section? It includes land, building, plant and machinery, shares, security, or fixed deposit in bank. However, to the extent to which any of these assets do not form part of stock in trade. Now, this is a logical exclusion. If you keep stock in trade, which is also an asset within the purview of this section, then it is impossible to survive. Take a case of any company which is doing business. If the assessment is carried out against a company, then even a transfer of stock, that is a sale of stock, if it is treated as a transaction which is to defraud the revenue, then it would be impossible to survive for the business without a sales and purchase transaction. So consciously they have kept this as outside the provisions of the law. Provisional attachment to protect the interest of the revenue. Now this is also very, very interesting and important section, which quite extensively, practically, those who have experienced the search and survey related matters, they would find that 281B is quite extensively used by the Income Tax Department in the matters of search, where the search takes place and prima facie some evidences are found that assessee has carried out the transactions which are not disclosed, or assessee is found to be possessing a lot of undisclosed assets, foreign assets, or whatever it may be. In that case, while the proceedings will continue for a period of, say a year or so, or more than a year as per the limitation period, during that time, to ensure that assessee does not part with his assets, or does not fabricate any of his books of account, then assets are kind of provisionally attached and books of accounts are also seized. So this is what exactly is the intention of section 281 capital B. Just read it once. Right? So the prior approval of the principal commissioner, so that is, I think it goes without saying. But the important part here is that if the AO is of the opinion that it is necessary to do so for the purpose of protection of interest of revenue. Now, this is very important. Formation of opinion. So it is not that in every case where there is a proceeding going on and the assessing officer has got a discretionary power that he can provisionally attach the property. Attachment of the property means directing the assessee and also the concerned authorities. For example, if you have got a bank account, you have a bank balance, and you have a fixed deposit in a bank, the tax officer will issue the notice. The tax officer will issue the notice and to the assessee as well as to the concerned bank manager, directing for freezing of the bank account so that no transaction can take place. It can only be, kind of under the authority of the officer, you can do any kind of transaction. And apart from that, the bank account of the assessee is attached. Likewise, if you are owning an immovable property, the assessing officer can direct the registrar of properties to attach to kind of a freeze the any kind of movement. Kind of, you can enjoy your property, but you will not be able to part with it or sell it. So that is provisional attachment to protect the interest of revenue. But as I said, and you can see the portion which is highlighted, the assessing officer has to form an opinion that it is necessary to do so for the purpose of protection of interest of revenue. And that opinion has to be approved by the commissioner. It is not that in a casual manner, in any attachment, in any proceeding, the AO can attach the property. What could be that opinion? That opinion could be that assessee is likely to escape escape from the country, is likely to move outside of the country, or where there is a likelihood that the amount of demand to be raised is going to be materially higher or at least equal to the amount of assets that the assessee possesses. So to ensure that he doesn't part with that asset, he can ask for it. If the amount of demand which is likely to result out of proceeding is not that material as compared to the amount of assets that the assessee has, in that case, definitely the provisional attachment is not done. Now, when the provisional attachment is done, do we have the tax liability determined first and then we do? Answer is no. It is only during the pendency of during the course of proceeding, not otherwise. So provisional attachment can be done with, but of course, as I said, with the fair estimate and the reasonable grounds. What is the validity of provisional attachment? 6 months. The attachment will be valid for 6 months and thereafter it will automatically vacate. Of course, for reasons to be recorded in writing and subject to the approval of the prescribed authority, that period can be extended as per the law. The total period of extension in no case shall exceed 2 years and 60 days or 60 days after the date of assessment, whichever is later. So the extension, even if granted, the total period of extension will not exceed 2 years, or 60 days after the date of assessment, whichever is later. So if the assessment order is already passed, then the extension for provisional attachment at max can be for 60 days after the date of attachment, or 2 years, whichever is later. Now, it was found that at some point of time, there is always a chance of misuse of this provision, which, creates a lot of economical challenges for the taxpayer. So therefore, the Tax Simplification Committee, what they recommended, said that instead of provisional attachment, if you are going to take this extreme step at any point of time, it is recommended that the assessee should be asked to furnish the bank guarantee subject to fulfillment of certain conditions. So how does this operate? The assessee will visit the bank. He will say to the bank that you have to give guarantee to the tax office on my behalf that in case I fail to pay the tax demand after the completion of assessment, bank takes the responsibility to make the payment. Now, bank does provide this service, of course, subject to certain conditions like do the create the mortgage and all those things, or based on your credit history. So this, I think, was the recommendation which was made by the committee. And accordingly, the amendment was carried out. Section 281B, subsection 3 to 9 provides for furnishing of guarantee in lieu of a provisional attachment. Now, of course, there's always a question of valuation. If there's a provisional attachment, so subsection 4 says, for the purpose of determining the fair market value of the property which is provisionally attached, the AO may make a reference to the VO, valuation officer, who is required to estimate the fair value of property and is supposed to submit the report to the AO within a period of 30 days. Time limit for passing the order revoking the attachment. Now, what is revocation? When you invoke the provision, when you attach the provision, and when you remove the provision, these are the two different steps. If you remove the provision, remove the provisional attachment, that is treated as a revocation of the attachment order. So what does the section says? For ensuring the revocation of attachment in lieu of bank guarantee in a time-bound manner, an order revoking the attachment has to be made by you within the following time. In a case where reference is made to the VO within 45 days from the date of receipt of such guarantee, or in any other case within 15 days from the date of receipt of such guarantee. So once you give a guarantee, the order of attachment will be revoked. AO is empowered to invoke the bank guarantee for failure to pay sum which is specified in the notice of demand. Power to invoke the bank guarantee. That means once you give a bank guarantee and thereafter if there is a failure to kind of pay the demand, then assessing officer can compel the bank to pay the demand, and that is nothing but invocation of the bank guarantee. So I'm not discussing something which is quite easy to understand. How do we adjust the amount which is realized pursuant to invocation of bank guarantee? Now, the amount realized by invoking the guarantee will be first adjusted against the existing demand which is payable by the assessee. And if there is any balance, like over and above what was required to be paid if you have recovered, then it has to be deposited in the personal deposit account of the commissioner with the Reserve Bank of India or State Bank of India or any of its subsidiaries as its agent at the place where principal commissioner is situated. So there would be a provisional deposit which would be created in a specified account. In case where AO is satisfied that the guarantee is not required anymore to protect the interest, he can kind of release the guarantee immediately. So understood? If there are any queries, I'll just pause for a while. Please ask.
Hello.
Hanji. Yes.
Sir, my question is that after invocation of the guarantee, bank guarantee, the tax payable is, say, example, guarantee given is for 1 crore. The amount payable, tax payable is only 80 lakhs. In this case, 20 lakhs is excess received from the bank upon invoking the guarantee. The 20 lakhs obviously should go to the assessee, right? Why it's depositing in the personal account of the principal commissioner or commissioner in the case?
That is the procedure. Assessee, practically, he can always ask that since now. So it is because that in a procedure, when you invoke the bank guarantee, you direct the bank to make a payment. So how procedurally it happens? Once there is a tax demand, the tax demand notice will be issued to the banker, and banker will be directed to pay the tax challan on behalf of the assessee. And the remaining amount, which is lying with the bank, it would be transferred in the specified bank account. Then the assessee approaches the tax officer, jurisdictional officer, to release all the assets which are left out after satisfaction of the demand. And those assets are then released to the assessee. So that procedure will have to be carried out where the department will then release the asset. And in all likelihood, these provisions are invoked in the cases relating to search and seizure, where the assets are always seized by the department. That is, department takes control of the assets, whether it is a cash or anything else. Likewise, if you furnish kind of a bank guarantee, the amount remains with the bank, but then bank is directed procedurally that you pay the demand and remaining amount will be deposited directly in a prescribed account. And from there, you do a formal request to the assessing officer. Assessing officer will do the fair estimate. Everything has been paid. There is nothing due. And then finally, the amount is received from the department. It's a procedural part. I agree, there is no logic in this provision. Ideally, there should not be a deposit at all with the SBI or Reserve Bank of India once the amount has been paid. But this is how the provision is, and we have to follow the laws of the land. There is no logic behind it as such, just a procedural provision.
Yeah, actually, this section is not favoring to the assessee.
Yes.
But when the department is need the money, they are invoking immediately, they are releasing it.
Yes.
But upon the completion of the assessment, why unnecessary they are keeping the amount of the assessee? That is
Yes.
what my question is.
Yes, that is true. But sometimes what happens, see, when you deal with the government authorities, practically, how it happens is it always takes time for the government machinery or bureaucracy to ascertain everything. So if there is any kind of, for example, they recover the money and then immediately they ask the bank, okay, now you release the money. What happens after that money is released? Bank is free, assessee is free, and subsequently, if you find there was an arithmetical error in the demand, or there was something which was left out to be properly assessed, if there is any rectification which is to be done. So these are all the factors. And as I said, it is only in very rare situations or in certain situations these attachment orders are passed. In a normal course where assessment takes place, this step is not something which is usually taken up. It is only when, some SFIO investigation is happening, some enforcement directorate issues involved, or if there is a search and seizure, or assessee is likely to abscond the country. So in cases like these, this provision is invoked, not randomly in all the cases. So department that wants to protect itself that if we release it in favor of assessee and subsequently, let's say if he utilizes that money and you find that, okay, the demand was not 80 lakhs, it was actually more than 1 CR. So department again will have, have to chase the assessee, and that creates a difficulty. So it takes time to get the release orders and all. That's the logic. But I agree that ideally it should be otherwise. But that might be the logic of doing it through that route.
Right, sir. Fair enough.
Yeah. Service of notice. So section 282, 283, and 284. These three sections deal with the service of notice, and those who are going to practice in the income tax area, please note that. So what we do generally as an article, or many chartered accountants also you will see, or the clients also, when we receive the notice from the tax officer, what is the first thing that we should do actually? Now, this is something I'm talking practical now instead of theory. Before getting into the notice content, what it is asking the assessee to do, first always ascertain whether the notice which is issued by the tax officer, is it valid or not. Now, what kind of areas do you look at? When you receive a notice, let's say 143.2, which deals with the initiation of assessment, or it is 148, which asks you to file a return of income, or 148 capital A, which is inquiry before assessment. There are many sections, 263, 154. What is it that you do when you receive the notice, or as a person we do? We read the notice, we read the content of the notice, and we start complying with it. Whatever they have asked, we will furnish. But what we have to do is, these all sections have a lot of practical implication. First thing, how the notice has been served, whether it is served as per the manner in which it was supposed to be served. Can the assessing officer say that, okay, I was just passing through your home and I know you reside in this place, so please take this notice. So just by a handover, he gives you this notice and tells you, okay, can you please comply with this notice? Or can he ask his office peon, okay, go to the assessee's home and just give it to him and tell him to meet me tomorrow? Can he serve the notice like this? So first, when we receive the notice, always see how it has been served, number one. Then, who has served it? Whether the person who has served it, is he authorized to do it or not? Is he a valid and a jurisdictional assessing officer, or is it coming from someone who is not having a jurisdiction over my case? He may be a tax officer, but is he having a jurisdiction or not? Now, third, whether the notice issued is within the time limit or not. What are the time limits given? If you see section 148 capital A, the time limit of that 3 year, 3 months and 5 year, 3 months. Or if it is 148, then 3 years and 5 years. Is it 143.2? Then is it in accordance with the time limit or not? Is it 154? Then whether 4 years time limit is not. So all these things we have to satisfy. Collectively, these are called as a jurisdictional requirement. If any of these aspects are not being complied with, the notice is defective. So the manner of serving the notice, the person who has served the notice, the time limitation, the signature, in fact, the DIN also, the document identification number, whether notice has that DIN or not. And in addition, I think these are the 5 most important. Otherwise, you have got something to share with me. This is very important before you get into the matter. Okay, what is the purpose of issuing the notice? What details he is asking? When is he asking? All those is a secondary thing. Of course, important, but it is secondary. It's factual, merit, and legal. The first thing that you should do always is this: how it has been served. So in order to do that, you need to be aware of various sections like 282, 292B, 292BB, and limitation period provided under section 153. So everything is very important. 148 timelines. So let us read this. While the provision seems very, very simple, you read it, just keep it in mind. What is important is it has a huge practical implication. Permissible modes of service of notice. So these are the following modes: the service of notice, summon or requisition, or order, or any other communication under that. So see the language, whether it's a notice or it's a summon. Summon means what? The assessing officer is issuing a summon to present yourself before him or the prescribed authority. Requisition, or any order or any other communication under the Income Tax Act. So practically it says all kinds of communications which are being taking place under the Income Tax Act. They may be made by delivering or transmitting a copy to the person who is named therein. So you have to deliver or transmit to the person who is named in that notice. It cannot be like my notice is issued to someone else. No, the person whom it has been named. So it has to be served to me. How? So these are the manners: by post or the courier service which are approved by the CBDT. You can't just go to any kind of courier XYZ firm or any kind of courier company and keep a receipt and say, I have delivered it properly. No, it has to come through the prescribed or approved modes of couriers, or by post, or in any manner as provided in the Code of Civil Procedure for the purpose of service of summon. or in the form of any electronic record which is provided in the Chapter 4 of the IT Act, or by any other means of transmission as may be provided by the rules framed by the CBT. The rules to address for the addressee for communication. Again, the CBT has been empowered to make the rules providing for the addresses, including the address of electronic mail or electronic message to which communication may be delivered. And then addresses in case of different assessment. How do we get the notices these days? Previously, it was, of course, through the postal mechanism only the notices were issued, and it is very rare to see that any, in fact, practically, I have not seen any courier agency being appointed by department to deliver the notice. It is always and generally the post office that serves the notice. But now we are moving from the manual assessment, physical assessment to virtual assessment and notices. And we are living in a technology world. So the service of notice is now happening only through uploading of that communication on the income tax portal, and that communication should be reflected in your login credential. Once it is there in your inbox on the income tax law, it is automatically forwarded to you either through SMS or through email that, hey, look, you have received some communication from department, have a look and comply with it. So that is also deemed service of notice as per the income tax law, and it is valid. The addressee, whom do you address? In case it's a firm, you can address it to any member of the firm, not necessarily to the managing partner or the partner of the firm, any member of the firm. In case of an HUF, manager or any adult member of the family. In case of a company, please note that in case of HUF, they're not saying karta. The wording they are using is manager or any adult member of the firm. So practically, the question comes, is assessing officer required to be aware of who is the adult member of the firm? How can he make out that who is the adult member in the firm? And HUF means what? It's a Hindu undivided family. It's a family. And the members are born every other time. So the size of the family increases by the birth of a family member. So how would an assessing officer know who is in your family? But this is how it is. Manager or any adult member of the family. Company, the principal officer. Now this is very easy to ascertain. In case of a company, the return of income is to be filed by the managing director, but then there are various other compliances where the principal officer takes care of it. And now you see that when we create a login credential on the income tax website, there they ask, what is your mobile number, what is your email ID, and who is the principal officer, primary contact person and secondary contact person. So all this is important. Local authority likewise. So AO is supposed to look at it and do the communication on that person only. If he does it otherwise, then that is non-compliance with the provisions. And in case of a dissolved firm, again, any adult person who was a partner immediately before dissolution, so notice can be served to that person. So this is just informative. In case of a discontinued business, you can still, even after discontinuation, you can address it to the SSG. In case of firm or an AOP or any person who's a member of the time of discontinuance, or in case of a company, it's principal officer, the erstwhile officer. So this is how notice needs to be served. If it is served otherwise, probably the assessing officer has violated 282, and you can take a ground also, and you can win your matter that notice served was invalid. But as we discuss ahead, section 292 BB is very important, 292B, which talks about curable defect and incurable defect. If you are ready to argue, and if you argue before object to the assessing officer about the invalid service of notice, then your duty is over. Even if he passes an assessment order, you can win in the appellate forum. Authentication of notices and other documents. Now, we talked about to whom the notice needs to be served and how it needs to be served. Now, we'll discuss the authentication. What is authentication? It's a validity of the notice, which it gets through the signature. Now, where any notice or document is required to be issued by the authority, any notice or any document which is required to be issued by the authority, such a notice or document, it should be signed and it should be issued in paper form or in electronic form in accordance with the procedure. Now, this is to provide adequate legal framework for paperless assessment technology. Rule 127, which has been amended, it says, in case of a situation where it's an electronic mail or electronic mail message, if the notice or document is in email, then if the name or office of such authority is printed on the email body and the email is issued from the designated email address of such income tax authority. If the notice is in the attachment, that is when he's sending the email, if the notice is in the body of the email itself, there is no attachment, then you have to satisfy point 1. If it is in the attachment, then if the name and office of such authority is printed on the attachment itself, and the email is issued from the designated email address of such income tax authority. So when you receive the email, you have to see that the email has got name and designation of the authority. And in the attachment also, it bears its signature and the required information is printed on the notice. It can't be on a plain paper, like he'll just type it, send you the PDF or a Word copy. No, it is never like that. Electronic records, so the provisions are almost similar. Just read it. If you have a query, we can discuss about it. But if a notice doesn't have a signature or a valid digital signature, in that case, that would be deemed to be treated as an invalid notice, and you are not supposed to either comply with it, and if you comply with protest. Say that the notice is invalid. Now, submission of statement by producers of cinema, movies, or persons who are engaged in specified activity. Now, Section 285 capital B, it kind of puts a reporting requirement. So this is just a reporting requirement for those who are meeting certain thresholds or entering into certain transaction meeting those thresholds. Who is that? The producer of a cinematographic film, or a person who is engaged in the specified activity. Let's see first what is specified activity. Specified activity means any event management, documentary production, production of program for telecasting or television, or over-the-top platforms or any other similar platform, or sports event management. So the section covers these activity as well as those who are engaged in the movie or cinema films. What is the time limit for furnishing the statement? 285 read with Rule 121A. It requires the producer of a film or a person who is engaged in the specified activity, or both, during the whole or any part of the financial year to furnish the statement within 60 days from the end of the previous year. How do you furnish it? So it's all online. Prescribed form needs to be filed online. What is the prescribed form? Form number 52, capital A. So in this form, you have to file it.
Sorry, is there any specific reason to submit this kind of statement to income tax?
I think there should be form 52A online, which should have been specified. Let me check. As we are speaking, I can check it and show you. It should be, and if it is not there, let's say, and there's a general rule, if it is not there, always file it with your jurisdictional assessing officer within the prescribed time. But let me see, as you are speaking, it is, very interesting query you have put in.
And also, is there any specific reason for the submission, sir, the statement?
Just a second, let me see it. See, in case of those event management and cinema producers, it is very important to kind of keep track of expenses they are incurring in cash or other than cash, because if you see, they are not into the normal business. And this section was introduced way back. Now the movies are, produced probably in some cases you see in 1 month or 2 months time the entire movie is shot and it goes for release. Whereas in some cases the movies, or at some point of time, it used to take the years to produce a movie, sometimes 2 years, 3 years, 5 years. So the expenses are incurred for a period of 2 years without any visibility around revenue. And then once the movie is ready for release, you earn the revenue maybe in 1 week or 2 weeks. So if you see, the production phase is more than a year, or it is a time consuming thing, whereas the revenue generation activity, it's only a matter of few days or few weeks. So this reporting requirement is basically to kind of track the genuineness of the business, and also a kind of a visibility that okay, this is the expense they have been incurring, and it is not something that, let's say you have got a huge cash in your books and at one shot you say that okay, after you made a movie, after 3 years you say okay, I gave Mr. X 5 lakhs, Mr. Y 10 lakh, Mr. Z 15 lakhs in cash. So all those things, kind of create a lot of difficulty from an assessment point of view also. Whereas if you say that, okay, I have made these payments as I'm doing the activity, it's a self-assessment thing. So in law, I think sometimes there is a logic, sometimes there's only a magic. Yeah.
I think to identify the source of expenditure, how the generation may be
possible. Yes. Source is also possible. I'll just share yes. If you go to the income tax website, they have now form 52 capital A. Form 52 capital A under a miscellaneous section. Persons who are doing the business, they are allowed to file it online. So they have now introduced this requirement online also. You'll be able to see it once you log in. But yes, that can also be the reason where the source of expenditure can be examined as you are incurring the expense.
Is it a voluntary nature, sir? Is it voluntary, right?
They are using the word me. Just a second. Section 280. See, if it is voluntary, then the section itself is redundant. It appears that the section is mandatory wherever there is a threshold breach, that the statement would contain the particulars of all payment exceeding 50,000 in the aggregate made by the person or due from him to each person as is engaged by him in such production or specified activity. So it seems that once you breach this threshold, you are expected to comply with this section. Otherwise, what is the use of it? Yes, please.
Right, sir.
And just sharing an interesting incident in UK. There is a tax authority which is called HMRC. Just for your knowledge purpose, not relating to this. In UK, if you produce a movie, there is a tax rebate that you get. I think they have recently revised it. It is 25%. Like in India, earlier we had section where if you do the scientific research, right now also I think there is not sunset that if you do some research activity, then there is an additional tax deduction that you get. Like if you incur 100 rupee, you get 150 rupee deduction, or you get 200%. And in some cases, if you just contribute, and you get a double deduction, section 35 and all. In UK, specifically for movie producers or those who are into this industry, not event management, for them there is an incentive where if you incur an expenditure over a movie and that movie is approved by the a board, like in India we have a censor board, there also there is a BFI. So if the board approves that project and the movie duration is more than 100 minutes, they give you a rebate, and that rebate is allowed even after you file the return, and then you can just amend it and claim the rebate, and that is about 25% of the total expenditure that you incur on a movie. So they are also kind of having a requirement where you have to file it. I don't see there is any other provision under the Indian Income Tax Act which gives this kind of rebate to the movie producers. There is no such. So logically, there doesn't seem to be any kind of logic behind seeking this information. But yeah, be that as it is, that is a requirement of the law and we have to comply with it.
I think to prevent money laundering or something on this case, I believe this section.
Money laundering exists in every business. See, it's not, I mean to say the money laundering may exist anywhere, not necessarily in relation to those. But yeah, the movie production it's a kind of a business where you earn in a period of 1 or 2 weeks, but it takes a substantial period of time when you keep on incurring the expenses. That can be the objective, but then income tax authority is not the one which is responsible for money laundering matters. They are only concerned with the tax matters. If it is a money laundering case, then of course we have a PMLA, Prevention of Money Laundering Act. They have got their own kind of administration and they should have any kind of reporting. So to my mind, money laundering may not be the reason to kind of introduce this section. But yes, you never know. Probably, yeah, it is good to see the memorandum explaining the finance bill, which has introduced this section. So that will kind of, help to ascertain what was the objective of bringing this section. So this, you can, kind of, for your curiosity, you can definitely search in which year the section was introduced, and in that year, what did the memorandum contain any kind of specific information saying that, okay, this is the logic. Or if the memorandum has not got any kind of such information, you can probably go through the budget speech if it is mentioned there. So it's very important to always see the logic behind the section. So
yes, sir. You could not ascertain the reason behind. That's what asking.
Absolutely. No, absolutely. See, if you know the reason, generally what happens, these sections are important. But if you know the reason, then you don't have to remember it or memorize.
Yeah. Yes, sir. Correct.
Kind of. And the examination is not the only thing. A lot of practical things will come as you become a chartered accountant. So
yes, sir.
So very, very useful if you know the logic.
Yes, sir. I'm also thinking on the other end, you say economic interest of the country to protect that. Also, this may be the case. That's
yes. All those things. Yes, absolutely. Obligation to furnish statement of financial transaction or reportable account, 285BA. Now, I think what you were trying to connect has, kind of a direct relationship with section 285BA, which is, kind of in the interest of economy to ensure that there is no tax evasion which is happening, and also to ensure that the source of income or source of expenditure is kind of properly investigated. It can be done only if you report it to somebody. So 285BA is one such section. We deal with this section almost on a regular basis. You would have heard the term Form 26AS, AIS, SFT. So what this section says, and this section keeps on, kind of from 2014, it keeps on expanding only in its scope or the coverage. See, so simply put, what this section is, we have got TDS section. The purpose of TDS section at some point of time was to, yes, of course, collect the advance tax in advance, but it was also to kind of create a reporting requirement. Because what was happening, if you allow the transaction to happen as it is without any kind of tax deduction, then there is a possibility that this income gets escaped from assessment. Because of the Indian population, it is not possible to administer each and every transaction. So if you do the TDS on a transaction, you file a TDS return. In the return of in the 26 years of the recipient, it will show that he has received XYZ income on which TDS is done. So when he files the return, the system only will catch that, okay, this was an income, you're supposed to offer it. If TDS was not done, you can easily kind of avoid this transaction. Or if TDS was done but reporting was not done, you can there are chances you can skip it. So that was the TDS purpose. Then they have expanded that in certain transaction, even if there is no TDS, we expect that you report it, and you report it before the due date. And the reporting is not only on an individual or a company, It is also on certain departments of the government. It is also on the stock exchange. It is also on certain specified persons. So what kind of transaction are we talking about? And sorry, what is it that is covered? Who are supposed to kind of do a reporting under 285 BA? An assessee. That means any kind of assessee, individual, HUF, AOPBI, company, firm, partnership, LLP, all those things. Any person, prescribed person in the office of government. So government is also a reporting entity. Local authority, registrar or sub-registrar appointed under the Registration Act. Any authority empowered to register motor vehicles. Postmaster General under the Indian Post Act. Collector, stock exchange, RBI, depositories, or financial institution, or any other person other than those. So practically they are saying everybody is supposed to do it. Specified financial transaction means any of the following transaction which may be prescribed. What kind of transaction are they supposed to report? Now we'll go one by one. Transaction of purchase, sale, exchange of goods or property, right or interest in a property. Transaction of service, works contract, transaction by way of investment made, or an expenditure incurred, or transaction for taking or accepting loan or deposit. But then there are, kind of, it's not that every transaction. Then there are certain rules framed around it. By when do we report it? By 31st May from the end of the financial year. So for financial year 24-25, the reporting requirement is till 31st May, and for the financial year 25-26, next year 31st May. You can, of course, rectify the reporting within 30 days from the date of such intimation. If there is an intimation issued to you for any kind of defect, you can just cure that defect. If there is a failure to furnish the specified financial transaction report, in that case, there is a penalty. So this is all procedural. If there is a discrepancy, they will reach out to you. They'll issue you. Now, I think they have got a centralized repository which issues, just like we have a CPC. The notices, I think, are coming from the Pune, where they are issuing the notices, and then you have to rectify it within the prescribed time. What kind of transaction and who is supposed to report it? Now, this is very, very important, not only for exams, but also for the compliance and practical understanding. If you make any payment in cash for purchase of bank draft or pay order or banker's check of an amount aggregating to 10 lakh or more. These days, you know that almost take a case of Chartered Accountants Institute. Our institute was taking the student fees earlier through a bank draft. Now, what is bank draft? You go to a bank, demand draft. You go to a bank, you pay certain amount, whether you have an account or not, doesn't matter. You pay the amount. The bank will ask you in whose favor you want a draft. Bank will draft it, and they'll take a cash and issue the draft. You give this draft to the institute, it is taken as a fees. They'll deposit with the bank, and then bank will credit the money in favor of institute. So that was the practice. Now it's all online. So we are moving from a world where there was a kind of a banking transaction done through the demand draft to an online transfer these days. So this provision was introduced basically to discourage the assessee to do the transaction in case cash for purchase of bank draft or pay order or banker's check of 10 lakh or more in a financial year. If they do it, the banking company is supposed to report it. Any second transaction, payment made in cash aggregating to 10 lakh or more during the financial year for purchase of prepaid instrument issued by the Reserve Bank of India. Cash deposit or cash withdrawal, including through bearer's check aggregating 50 lakhs or more in a financial year. So if you deposit cash or if you withdraw the cash aggregating to 50 lakh or more in a financial year in one or from one or more current account of a person. So the reporting obligation is on the banker. Yes, please.
Sir, what is meant by prepaid instrument issued by RBI, sir?
So in fact, even this would be, kind of recently we have not come across any such thing, and basically RBI issues at relevant point of time. There were certain transactions where you deposit the cash and they issue the instruments to you, prepaid instrument. There may be any bonds or securities that you can hold by depositing the cash. The question comes, how do you report that transaction? So RBI always accepts, even today also, if you go with the old note, RBI only accepts it. If you have any currency, you can deposit with an RBI and buy something. But the prepaid instruments were there at relevant point of time. These days, it is not in practice. So the obligation is on the bank to report this transaction. I think these days it is not there. What you will find is only serial number 1, which is bank draft, and serial number 3, which is cash deposit and cash withdrawal, as we usually do in a normal case. Second, cash deposits aggregating to 10 lakh or more in a financial year in one or more account, other than a current account and time deposit of a person. So again, this is on a banking company and a postmaster general as specified under the Indian Postal Office Act. If you do a time deposit, one or more time deposit, or of rupees 10 lakh or more in a financial year, then the banking company is supposed to do. So this is basically to ensure that, so what they do is when you do these transactions, there is no TDS. It is the bank which will report that, okay, Mr. X has an account, he has done these transactions, 285 DA limit is breached. They are going to report it in a prescribed form 61 or 68 to the Government of India. And this transaction will be reflected in your AIS. In your AIS, it is reflected. And then when you file the income tax return, the tax officer will kind of do the preliminary reading. And now there are systems. So the system will kind of, verify the data that, okay, you have filed the income tax return. In income tax return, the income you have shown, whether it is commensurate with the transactions you have done in your banking account. If it is not commensurate, then it is likely that your officer might want to scrutinize your transaction in little more detail. Yes, please.
Sir, what is the limit for time deposit is made? Other than time deposit is mentioned, it will cover under that 50 lakhs category, time deposit?
Okay, I'm just going a little back. So first one is bank draft, then specified instrument, then it is cash deposit. If your cash deposit or if your cash withdrawal, including through banker's check, aggregating to 50 lakh or more in a financial year in one or from one or more current account of a person, then, so of course it is a bank wise. If your account is with as State Bank of India, you have got one account or more account, you have to see cash deposit is 50 lakh or more, deposit as well as withdrawal. Aggregate all the account. In one account 40, in another account 10 lakhs, aggregate it and report it. This is about cash deposit, one or more current account. Second is about cash deposits aggregating to 10 lakh or more in a financial year in one or more accounts. They're not saying current account, it could be any account other than a current account and time deposit. So it would be savings account of a person. So if you deposit 10 lakh in a savings account, which is in cash in a financial year, if you have got one account or more account, doesn't matter, but it has to be with same bank, because different banks, you never know. The same bank, if you have more than 2 savings bank account, it is on the bank to report it to the Government of India. And the third is one or more time deposit, other than a time deposit made through renewal of another deposit. So it is a question of a fresh time deposit through a fresh investment. Anything which was there, it was redeemed or matured, and out of that, if you create a renewal, that is not covered. So one or more time deposit of a person aggregating to 10 lakh or more in a financial year of a person, then banking company or postmaster is required to report. Now, one very important and practical consideration, what mistakes we do. If you have got a time deposit of, let's say, 10 lakh rupees for a single year, the rate of interest is 7%. If you deposit the money in a bank and the bank does the time deposit, so let's say it's not a cash deposit, it is your own money you have earned through valid, let's say, salary income. you do a time deposit of 10 lakh rupees, fixed deposit for a period of 1 year or whatever it is, 7% interest. After 1 year, the bank gives you an option. Do you want to automatically renew it, or do you want the money to be credited in your bank account? If there is an automatic renewal of your time deposit, in that case, what happens? The money is not going to hit your saving bank account or a current account. It will automatically be renewed along with the interest which it has accumulated, right? Then the reporting will happen only once. That is the year in which you created the time deposit. In the second year, when money was matured, it was automatically renewed. It would not be treated as another time deposit which requires reporting. If you ask the bank to credit the money in your bank account, and once it is credited, and thereafter out of the same money, if you invest or reinvest, let's say same amount, that will not be treated as a renewal. The banks practically take it as a kind of a fresh fixed deposit, and it is a fresh fixed deposit, but in substance it is a renewal only. The only thing that you wanted to happen was the money should have been credited in your bank account, and from that the same amount of FD should have been done. Some people do this maybe for reporting purpose, to ensure that their money is safe and it is being, kind of, for old age people it is important to have the entry in a statement to recollect. Old deposit, they may not be able to recollect. It keeps on automatically kind of this thing. So this provision, many a time creates a challenge, but banks have been reporting it. If it is broken, even after maturity, if it is credited and created a fresh deposit, they are reporting it. If it is automatically renewed without entry into your saving bank account, then it is treated as a renewal for the purpose of reporting. So they are not required to report the renewal transactions.
Yes, sir. Perfect.
Payment made by any person of an amount aggregating to 1 lakh or more in cash, or 10 lakh or more by any other mode, against the bills in respect of one or more credit cards issued to that person in a financial year. So this is basically, if you take a credit card and you do the transactions of purchase or normal transaction, and if you breach these limits, then the bank or the cooperative bank which has issued the credit card to you, where you have got an account, they are supposed to report the transaction. So you see in your AIS these days, they'll tell you that, okay, this much amount you deposited to settle your credit card and all. So again, no logic on TDS, just for an information purpose. If you're filing the return of income, they'll come to know, okay, this is commensurate with the size of your income. Receipt from any person of an amount aggregating to 10 lakh or more in a financial year for acquiring bonds or debentures issued by the company or institution, other than the amount received on account of renewal of the bond or debenture issued by that company. So same logic, any company or institution which is issuing the bonds or debentures, they have to report it. Receipt from any person of an amount aggregating to 10 lakh or more in a financial year for acquiring the shares, including share application money issued by the company. So again, the responsibility on the company which is issuing the shares. Buyback of shares, I think the provision is no more, but yeah, for buyback of shares from any person other than the shares bought in, yeah.
Sir, on the point number 6, the receipt from any person of an amount aggregating 10 lakhs means we are receiving the money. As you are talking about loan?
No, it is like you form a company, right? You form a new company. The new company will allot the shares to the shareholders. And from an individually, single person, if they are receiving 10 lakh rupees or more in a financial year, who has acquired the shares of that company, then the company is supposed to report this transaction. Or even an existing company. Let's say there's a IPO of, let's say, Reliance Communication, a fresh IPO. And if you subscribe to it and you are allotted shares worth 10 lakh rupees or more, then obligations on the company to report this transaction under 285BA. And even if they take this amount as a share application money and report as a share application money, and there is no allotment which has taken place, even that is also required to be reported. And the moment you convert the share application transaction into an allotment, then on a conservative side, the company should report it. But prima facie, once it is reported, there's no need to report it once again. If it is in the same financial year, don't report it, report once. If it is a different financial year, so share application, once the amount is received, it is taken as a share application. Then after certain procedures, it is allotted to the shareholder, then it's an allotment. If both the events are happening in the same financial year, treat it as an allotment and report this transaction as an allotment. If both are happening in different financial year, conservatively, to avoid the penal exposure, one should report it. But then it is definitely going to create an unnecessary problem for the taxpayer, because same transaction gets reported in 2 different years. So that's how it is. But yeah, some companies report it only once. And one more interesting aspect I forgot to discuss, that was in relation to the fixed deposit. So what happens, there is always a tendency, particularly for senior citizens, they hold a single saving bank account, and in single saving bank account, they are the joint owners of that account. They are the joint holders. So they'll create some retirement fund. They'll keep a fixed deposit, which is through a joint account. And in a joint account, both the taxpayers, both the assessees will have their bank account and Aadhaar number linked. Now, when it comes to return filing, the money was of Mr. X. Mrs. X was just a second name in the account. She was not the owner of that money. It was earned by Mr. X, who filed his return of income regularly. Mrs. X is just a housewife. Her name is there in a saving bank account as a joint holder. Now, what practically problems everybody is facing, when the bank is saying that, okay, there is a deposit of 10 lakh rupees, they will report it with the government of India. It gets reflected under AIS of both the assessees, Mr. X and Mrs. X. Though Mrs. X has got nothing to do with it. She's just a joint holder or a nominee for that account. Joint holder. Now, what problem it is creating? Mrs. X has started receiving the notices for non-filing of return of income and having created the fixed deposit of 10 lakh or more. So department has started inquiring. So that is where a lot of taxpayers are facing a problem also. I'm not getting into it just for an academic interest. I'm sharing with you. So in that case, I think everybody has to file an appropriate response saying that Mr. X is the owner of that money. It's just out of confusion this is happening.
Yes, sir. If the notice is issued for both the party, then limit should be 20 lakhs, not 10 lakhs. That's what.
there should no. I respectfully disagree here, sir. There should be reporting requirement on a bank, fine, but they should ask all the joint account holders to give a primary account information. Only in the primary account holder it should be reflected, or they should ask some declaration that this money belongs to whom, in whose case do we report it. Or alternatively, if it is 50-50, then it should be reported 50-50. 5 lakh Mr. X, 5 lakh Mrs. X. Because then it makes sense, right? So, so that thing has not yet taken up, so everybody is facing a problem, but fine, yeah.
So my opinion also, if the primary party is responsible for that. See, if the notice issued to the primary party, then there is no issue at all. When the notice issued for both the parties, then limit also should be the 20 lakhs, 10 lakhs plus 10 lakhs.
Yes.
Then that case they are eligible to issue the notice.
Right, absolutely.
Otherwise they got to split the amount as you informed us. Is a 5 lakhs plus 5 lakhs.
Yes. So at least some clarity should be there.
Yeah, clarity should be there. Accordingly, they should advise us. The CBDT maybe issue some circular on this.
Yes, there should be some clarity. But this is happening for almost last 3 years. And it is quite a task for everybody to handle this. Receipt from any person for sale of foreign currency, including any credit card. So this is again relating to that. You are spending so much of money. So you should report it if you buy the foreign currency. Purchase or sale by any person of immovable. I think this provision should not at all be there, because if there is already a TCS and reporting is being done, then why do you want to repeat it again for 285 DA? But yeah, so there's a duplicate reporting. Purchase or sale by any person of immovable property for an amount of 30 lakhs or more, or valued by Stamp Valuation Authority referred to in 50C at 30 lakh or more. If you are going to buy the property, you are going to be seller of a property, whatever it is, if you meet this threshold, the registrar is going to file a report with the CBDT. Receipt of cash payment exceeding 2 lakh for sale by any person of goods or service of any nature, other than those specified in 1 to 10 above. Any person who is liable for audit under 44 weeks. So this is, the provision which is applicable to all the taxpayers who are subject to audit under 44AB. So if you are subject to audit under 44AB and if you are doing a sale in cash to a single person and the consideration is 2 lakh or more, singly or in aggregate, then you have to report this transaction to specified authority. Manner of application of threshold limit. The reporting person mentioned in column 3 of table so and so shall, while aggregating the amount or determining the threshold limit, will take care of the following. He'll take into account all the accounts of the same nature of the same table mentioned in respect of that person during the financial year. He'll aggregate all the transaction. He'll attribute the entire value of transaction of all the transaction to all the persons in a case where the account is maintained or transaction is recorded in the name of more than one person. So I think this is provision is there, but practically it is not being observed by the banks. So you'll apply the threshold limit separately to deposits or withdrawals in respect of transactions. For the purpose of pre-filing the return of income, the information which is provided relating to capital gain on transfer of listed shares or mutual funds, dividend or interest income will be furnished by the persons at such frequency and in such manner. Now, this is also very important and we are going to see this change very soon. Capital gains on transfer of listed securities or units or mutual funds. So now, these days, when you file the return of income, earlier it all started with the pre-filling of salary income. Then they extended it to other source where dividend and interest income was automatically kind of picked up from 26 years and it was reflected in Form 6 in the income tax form. Now they are extending this scope to even automatic calculation of capital gain on transfer of listed shares. So it is the stock exchange who is going to. So far they are providing AIS. In AIS they are providing all the transactions relating to sale and purchase. But the capital gain is still required to be computed manually. But I think with the simplification in the tax rates and the additional reporting requirement, it is now all going to be automatically populated in your income tax return. You don't have to do this exercise, just repeat it. Just have a kind of proper reconciliation done. So dividend income, interest income, this is these days kind of auto-populated. What is the penalty? 500 for every day during which default continues. 271 FA, failure to furnish the panel, statement of financial transaction or reportable account. So this is, I think, self-explanatory. So we are not discussing this provision in detail. So penalty for furnishing inaccurate statement. One was when you don't file it and another is when you file it, but there is an inaccuracy. Then the officer may direct the imposition of penalty of 50,000 subject to satisfaction of any of the following condition. The inaccuracy is due to the failure to comply with the due diligence requirement, or there is a deliberate attempt on the part of that person, or the person is aware of the inaccuracy at the time of furnishing, but he doesn't inform the prescribed income tax authority or the agency about it. The person discovers the inaccuracy after furnishing the statement, but he, even after discovery, fails to inform or furnish the correct statement within 10 days. Now, this is something I think it's very important for all of us to understand. What is CRS? Anybody is having idea what is CRS? An automatic exchange of information. It's really good to see the participation of students in today's session, because in previous session we had a less participation. So it's quite interesting. Anybody having any idea? CRS or Automatic Exchange of Information Framework. So see what happens. This is in a cross-border scenario. The taxpayer who is having operations outside India, or anybody who is a non-resident who is liable to tax in India, what is happening these days that if you enter into any transaction, let's say you purchase a cryptocurrency, you have a bank account outside India, you transact in the shares and securities in outside India, or you hold any asset outside India, there is always a treaty between India and that country. So far, the mechanism was the treaty, double tax agreement, avoidance agreement. There was a clause which requires or which allows either of the authorities in each of the jurisdiction to call or reach out to the other country and ask for the specific information relating to specific person, and that bank or that corresponding authority was supposed to facilitate that sharing of information. But now they have developed some tools and instruments which are called as CRS. One of the instruments is CRS, Common Reporting Standard, which designs an XML schema or kind of an exchange of information framework where this information is going to be shared whether or not it is requested by the other authority. So it is called as an automatic exchange of information without any need of requesting that information. Now, this generally, I think it has started with the crypto, with the stock exchange dealings, with the bank account transaction, and they are going to extend the scope of this reporting gradually over a period of time. So this is how it is. Annual Information Statement 285 BB. The authority or a person authorized by such authority, they have to upload in the registered account of the SSE and AIS in annual information statement in the form and manner and within the prescribed time. So whatever information that registrar, bank, post office, all. Yes, please.
Sir, on the CRS part, is the automatic capture, is any company or the person to be informed about it on the automatic exchange information? Who will be the in charge for updating that? My question is...
Okay. No, it is the tax authority. So no, so how it is going to work? So this is a framework which is created where, let's say, I am an individual, I have a bank account in Switzerland, or I do some trading in Switzerland. Now, I am an Indian resident. For Switzerland, I am a foreign citizen. So whatever information, financial transaction I carry out in Switzerland, the Switzerland tax authority is going to seek that information from the local bank or the financial institution there under their information framework. Certain standard information they'll begin with, and then they'll expand that net. Then that information, the authority through a CRS portal, they are going to automatically transmit to the Indian tax authority, or that information is going to be visible to the Indian tax authority. Then Indian tax authority can either import that information into AIS, or they can compare that information with my income tax return. If I invested in the shares of a foreign company, if I do not disclose that information, then it becomes very easier for now authorities to cross-verify that, okay, whatever is reflected on CRS, is it reflected in the assessee's return? If it is not reflected, they can kind of initiate the assessment under the income tax law, or they can invoke the black money law, whatever is applicable based on the transaction. So this has started. The law is evolving. And so the purpose of giving this background is that is not part of, I think, syllabus at this moment. What they are saying is the information reporting requirement. For example, the banks are in India, banks or share security market. For example, a non-resident or a foreign citizen, if he's investing in the shares of a company and the transaction value is more than 10 lakh, then of course the bank is required to report, or the company is required to report. So that information will be available with the department. They can put it into CRS. Another country can also have access to it. So it is both way. It is bilateral. It is not a unilateral reporting. So what this para essentially says is, while reviewing the India's CRS legislative framework under the automatic exchange, the Global Forum on Transparency and Exchange of Information for Tax Purpose, it has formed a view that the penal section available under 275AA for inaccuracies, it would not automatically extend to all cases where due diligence was not correctly done if the information did not lead to incorrect reporting. So that's just a remark just to understand that whatever frameworks that we develop for sharing of information, they're always peer reviewed by the foreign authorities. This automatic exchange of information framework is nothing but developed by the OECD under the Global Forum on Transparency and Exchange of Information for Tax Purpose forum. So that kind of reviews all the countries' tax laws and whether they are compliant with the standards or not, and then they kind of provide their commentary. So according to that commentary, with effect from 1st October 2024, an amendment was introduced, and it has been substituted to provide that the authority may direct the levy of penalty of 50,000 subject to satisfaction of following: the person who provides the information in the statement or fails to furnish correct information within the prescribed time, or the person fails to comply with the due diligence requirement under 285BA. In either of these cases, he is supposed to pay the penalty. AIS. So this is nothing but the additional requirement on the part of tax authority then to put all the information into the assessee's account so that it is reflected to the assessee when filing the return of income. A registered account is nothing but your income tax portal where you log in through your PAN number and password. So there is a 26AS which you see in your income tax portal. This is the information that is available. So all this is coming out through a statutory mandate which is given in 285BB. So this, I think, is self-explanatory. Appearance by registered valuer. Any taxpayer who is entitled to or required to attend before authority or the appellate tribunal in connection with any matter relating to the valuation of any asset. Otherwise, then he is required under 131 to attend personally for examination or not. He may attend by registered valuer. So if you want to ask any query to the taxpayer relating to the valuation of any asset, he can always ask an authorized representative who may be a registered valuer to appear on his behalf. However, this is subject to an exception, and that exception is section 131, where the officer wants the personal attendance of the taxpayer to examine that person on oath or on affirmation. So if you want to take him on oath, then you have to you have to appear personally, otherwise you can appear through registered. Yes, please.
So, what are the situation section 131? It's saying the person assessee should attend. Any idea about it, sir?
So it is written here only where the statement on oath is required. Generally, what happens in case of search operations or in case of survey operations, you see something during the course of search and you want to inquire something from the assessee. Now, when you do this inquiry, of course, it's an oral inquiry, but you ask the assessee to come and answer the questions, sign that statement. This is called a statement on oath. Now, statement on oath can be given only by the person to whom those assets or to whom those undisclosed income or to whom those transactions relate. You can't ask an authorized representative to give a statement on oath on behalf of the person who is in charge. It's very similar. It's like if there's a court matter going on, you allow the lawyer to represent you in the court of law. But when it comes to giving any kind of statement to the court, which requires your personal attendance, then you cannot say that, okay, now for this, the lawyer will appear and he will give on my behalf. It is a mandate of the court. Court wants you to be there. So you have to be there and give it personally. So it is same. Section 287 says that you have to come under Section 131, personally attend and give an examination on oath. So you can't do it through a registered valuer.
Okay, sir. Thank you. Got it.
Yeah. Appearance by authorized representative. Procedural section, but yes, very important to kind of go through once. Section 288 deals with the appearance by authorized representative. Any assessee is entitled to or required to attend before authority or tribunal in connection with proceeding under the Act. So this is about any proceeding. Any income tax authority includes your assessing officer. It includes the Commissioner of Income Tax Appeal, Joint Commissioner, Commissioner, Director General, Chief CCID, Principal CCID, any authority constituted under the Income Tax Act. And the appellate tribunal, of course, if you want to appear before a tribunal, in that case, you can attend personally or through an authorized representative. Again, the same exception. Otherwise, then, where a person is required to attend under Section 131 to attend personally for examination on oath, he may attend by an authorized representative. Now, who is an authorized representative? These are the qualifications and requirements as we move ahead. So you can just go through a person relating to an assessee in any manner, or person who is regularly employed by the assessee. So even an employee can be an authorized representative. Officer of a scheduled bank with which the assessee maintains a current account. Legal practitioner who is entitled to practice in any civil court in India. That means a lawyer. An accountant can be an authorized representative. And the accountant is defined as a CA who holds a valid certificate of practice. Now, who is not covered? Following are not covered. A company cannot represent an assessee. A person is not eligible for appointment as auditor of a company. In case of a company, a person who is not eligible for appointment as an auditor of the company, he cannot be appointed as this. So then there are different criteria. So this is how the list goes. I think in first session we have discussed this in detail, so I'm not kind of getting into each of this point because we have chapter I think 17 also to cover. This is also very important, which we generally lose sight of. Any person who has passed any accountancy examination recognized by the board. Rule 50 prescribes the accountancy examination recognized for this purpose. They are National Diploma in Commerce, which is awarded by All India Council for Technical Education under the Ministry of Education. So this is even final examination of the ICAI, final examination of the Institute of Costs and Works Accountant. So they are also eligible. Any degree in commerce or law which is conferred by the following universities. So now you see this is all external university. Irish University, Pakistan universities, Scottish universities. So now this is basically, I think, an outdated thing these days. It had relevance at some point of time, but yeah. In fact, English and Welsh University. Any other person has maybe prescribed. So the following person shall not be qualified to represent. So it is also important to note who has been dismissed or removed from the service of government, who has been convicted of offense, somebody who has been insolvent, declared insolvent, person convicted by court of offense involving fraud. So likewise, there are various situations. There's no option but to remember them. So after this, I think we'll take a break and then we'll spend some time on the chapter 17. Yeah, so let us take a break, and then we have, I think, two more sections to discuss, and then we go to chapter 17, which is a very small chapter. Ashokji, break? Okay. So 291, it empowers the central government to grant an immunity from prosecution. So there are, various sections under the income tax law which provides that in case one of the famous section 276B, where if you fail to deposit the TDS which you collect, then there is an imposition of penalty, of course, but then the CIT has got an authority, has got a power to prosecute the assessee. That is, he will file a complaint before the magistrate court, and the court will kind of pass an order after a trial. Now, what is Section 291? Let's read it verbatim. The government is empowered under the section to tender any person immunity from prosecution for any offence under that. If the government is of the opinion that it is necessary and expedient to do so in the public interest for the purpose of obtaining evidence directly or indirectly concerned in or privy to the concealment of income or to the evasion of payment of tax to any income taxable under that. So there are two things. One is immunity, which can be granted by the CIT. Now, immunity granted by CIT is, for example, if you pay the tax after an assessment order is passed, then you can file an application. If it is a case of underreporting of income, you pay the tax. We have discussed this in some session. Then you are granted an immunity from the penalty and prosecution as well. And likewise, the CIT also has a power to waive the kind of launching of prosecution. But this section is slightly different, where the government is empowered to grant an immunity. So this section is slightly different in a way that the government is empowered to grant an immunity if it is in the public interest to do so, or if while granting the immunity, the government is satisfied that the conditions of these sections are satisfied or the situation compels it to do so. The immunity made to or accepted by the person concerned shall to that extent render him immune from prosecution for any offence for which the immunity was granted. Now, if it appears to the government that any person to whom immunity has been tendered under this section, he has not complied with the conditions on which the immunity was granted, or he is willfully concealing anything or is giving false evidence, the government may record a finding to that effect, and the immunity may be deemed to have been withdrawn. Now, any such person who is tried for the offence in respect of which immunity was made, or for any other offence for which he appears to have been guilty in connection with the matter, may be liable for imposition of penalty under the act to which he would otherwise have been liable. So this, granting of immunity would not be immune from penalty. If it is revoked, then you have to undergo this thing. Section will just touch upon section 292B now. This is important, and then we go to the chapter 17. Section 292D. Return of income not to become invalid. Now, any mistake or defects in the return of income would not render it invalid if it is a curable defect. What the section says: no return, no order of assessment, no notice, summon, or any other proceedings furnished or made, taken, or purported to have been furnished or made in pursuance of any provisions of the law will be invalid. Now, what is important to note here is merely by reason of any mistake, defect, omission in such return, notice, assessment, summon, proceeding, if in substance they are in conformity with the provisions of the law. So it is saying that any immaterial breach, immaterial defect, immaterial non-disclosure would not render the return or notice or any proceeding invalid. And if it is a mistake, defect, or omission. Now, these, if you see mistake, omission, and defect, they should be something which is, which you can prove that there was not a malified intention to do that, or the mistake was such which was not, mistake is never a conscious. Mistake is mistake. You did it unconsciously, or you didn't do it intentionally. So all those factors will play a large role to say that 292B cure is there or not. Likewise, notice deemed to be valid in certain circumstances. So the tax officer issues a notice during the course of proceedings. If you participate in the proceeding, I think we discussed in the last session, day before yesterday, but we said that if you participate in the proceedings without raising any objection, then even if there are procedural lapses in issuance of notice in connection with the proceedings, the mere fact that you participated and did not raise the objection, it is not going to invalidate the proceedings, because as I mentioned in the beginning, when a taxpayer is receiving a notice, while we fight on merits, we provide the information, we kind of adjudicate and we kind of participate in the proceeding. That is one part of it. But whenever we receive the notice, we have to see that it has been served properly as per the law. It has been issued to the correct person. The notice is carrying a DIN, document identification number. It has properly been addressed. It has been served in the prescribed manner. It has followed the timelines, statutory timelines. All those factors are supposed to be, adhered to. If there is a breach of law, then you can always, in the appeal proceedings or even before the courts, you can argue that the notice is invalid. And the courts have accepted it and they have quashed the proceedings in many cases. But if you participate in the proceedings, whether it has come to your notice or not that the notice is invalid, it has not followed the process of law. If you participate, then it would be deemed that the proceedings are valid. You cannot question the proceedings as invalid, even if it is found that there was a major procedural lapse. So this is the content of this section. Just have a look, and if there is any query, please let me know. So as you see, the deeming provision will not apply where the assessee has raised an objection before the completion of assessment or reassessment. Once the assessment is complete, you can't do it. It is very important that before you, even if you participate, but before the order is passed, if you raise the objection, an officer is supposed to deal with it and dispose it off. Presumption as to assets, books of account under section 292C. Now, this is a presumption in regard to the ownership or the relevance of an asset of a document which is provided under the law. When a search is carried out, just take an example, and during the course of search, the assessing officer will find certain assets, certain transactions, which are in your control, which are at your premises. Now, the law says you can presume that those content in the books of accounts, those documents relate to the assessee. The transaction mentioned therein have been entered by the assessee. If you are found to have any asset, you can assume that it is owned by the assessee. If there is any entry in the books of account, if there is any agreement which is found, it is presumed that it has been executed by the assessee and it belongs to the assessee. This is a presumption of the law. And then the onus is on the assessee to prove the otherwise. So let us read it once. 132.4a. It is in section 132.4a, which relates to the search assessment. It is provided that the books of account, money, bullion, jewelry, or other valuable article found in the possession or control of any person in the course of search will be presumed to belong to that person. So that's a presumption we discussed. It is further provided that it will be presumed that the content of such books of accounts, they are true, and the signature in every other part of such books of account and other document which purport to have been in the handwriting of any particular person, or which may reasonably assumed to have been signed by that person or through his handwriting, or in case of a document stamped, executed, or attested, you can safely presume that it has been done by the person by whom it purports to have been so executed or assessed. This is a presumption under 132.4a. 292C, it was inserted to clarify that the presumption can be made in any proceeding under the Act. It would also be available for regular assessment, not necessarily search. The section provided that where any books, documents, money, bullion, jewelry, or valuable article is found in possession or control of a person in the course of search or survey in any proceeding under the Act, it may be presumed that those documents, books, content, or entries in the books of account, money, bullion, jewelry, or other valuable article or thing, or signature on any part of the document, or in case of any agreement, stamped, executed, attested, it has been of the assessee, there is a presumption under the law, and then the assessee has to prove otherwise before the assessing officer and in the proceeding before the appellate authority. Now, it is important to note that presumption is not only in relation to the assets, as I said, it is also in relation to the books of accounts, documents, and assets which are delivered to the requisitioning officer in accordance with the provisions of 132A. Two 93C, again, not much to discuss. In the earlier session we have discussed, so just go through it, small section. If there is any query, we can, or otherwise we can move to the chapter 17, which is, I think, which is going to take more than half an hour to discuss. We have a limited time. Like section 12 AAUC, section 1023C, section 80G. So there is a power given to the CIT to grant you an approval. And there is also a power for cancellation of your registration. There are certain cases where there is a power that you go to the authority and authority is going to give you an approval. But there is no such power to withdraw those approval. Wherever it is, then section 293C empowers the income tax authority to resign that approval or to cancel the approval which is granted under the provisions of the Act. So this is a rule granting. So let us now move to the important chapter 17, and then we deal with some of the questions that we have. Dispute resolution. Now, please note that this is different from the dispute resolution panel, section 144C, which we discussed in chapter 14, assessment procedure. That is an entirely different section in terms of process, in terms of the manner of conducting the assessment. Everything is different, and this is a different chapter. What is the kind of the purpose of this section? Let us try to understand. The purpose of introducing this section into the law was to like we have CIT appeal as a first level appellate authority, and we have seen that there are certain orders which are appealable before CIT appeal under 246, before Joint Commissioner, 246 capital A, before Commissioner of Income Tax appeal. Now, for disposal of matter at CIT appeal level, there is a time limit, but it is a directory, it is not a mandatory. So it takes a lot of time for disposal of matter at CIT appeal. There is an uncertainty about the time. Under 144C, there is a mandate given that against a draft order, you can go to dispute resolution panel. Panel consists of commissioners of income tax, and they are bound to give the directions within a period of 3 months. But it is available only to the eligible assessee. Who is eligible assessee? The foreign company, which has faced the kind of foreign company or non-resident who has faced any kind of variation, and the Indian company or foreign company which has been subjected to transfer pricing adjustment by the TPO. Only in those two cases, you can approach the DRP for quick redressal, which is 9 months. And then, based on the direction of DRP, you get an AO's order, final order, and from there you go to tribunal. So the journey from AO to tribunal is quite quick if you opt for a DRP route. If you opt for a CIT appeal route, there is no time-bound resolution or appellate process. So for quick redressal and also for addressing the concerns of small taxpayers who are facing small additions and those who would want to kind of settle at once and would want to avoid the penalty, the repetitive penalty and prosecution. So to avoid all those multiple proceedings, this section was introduced. If you see, in normal course, if you are facing an assessment, once order is passed, immediately penalty proceedings are initiated. By the time you reach the tribunal, the penalty is imposed. So there is a multiplicity of proceedings that one has to face because of an order passed by the income tax officer. Whereas if you opt for this section, you get a kind of a resolution which is faster, and number two, it avoids multiplicity of proceedings and gives, in certain situations, immunity from penalty and prosecution. Let's read the section. Section 245 MA. It talks about the constitution of Dispute Resolution Committee. As I said, the Dispute Resolution Panel, which is DRP under section 144C, it is completely different than Dispute Resolution Committee, which we are going to discuss. That is also an alternate forum where you can file an appeal. You have CIT appeal, you have DRP, and you also have got a Dispute Resolution Committee. For CIT appeal and DRP, there are certain conditions, appellable order, and likewise for DRP also certain condition. Only when you satisfy, you can file a petition before the DRC. Let's call it a DRC. Now again, the central government, section 245 MA is an enabling section which empowers the central government to constitute one or more dispute resolution committee as per the act. The committee will consist of person or class of person as may be specified by the CBDT who may opt for dispute resolution under this chapter. What is going to be the composition of committee? So each DRC not necessary there will be one, there may be multiple DRC. However, they'll consist of 3 members. Like in DRP, we have 3 members. In DRC, we have got 3 members. 2 members shall be retired officers from the IRS. 1 serving officer not below the rank of principal commissioner who would head the DRC. Members shall be appointed by the central government for a period of 3 years. The decision of DRC shall be by the majority. So in 3 members, 2 members, if they grant a favor and 1 member has a different view, then the decision by the majority would be binding on the particular matter. Application for resolution of dispute before the DRC. So who is supposed to file an application, in what circumstances, what are the conditions? Now this is a key provision, Rule 44 DAB. DRC is going to resolve the dispute in case of person who opts for the dispute resolution under this chapter in respect of disputes arising from any variation in the specified order in case, and the case is one which fulfills the specified condition. So 2 things important, specified order and specified conditions. What is it? Let's see. The fees is 1,000 filing fees. In CIT appeal, there are slabs 250, 500 and 1,000. Whereas in the DRC, there is a single, straightforward 1,000 as a fee. Now let's see what is specified order, and then we see specified conditions. What kind of orders are covered? The order, like in 246 capital A, we had list of appellate orders which are subject matter of appeal. In case of tribunal also, we had list of orders against which we can file an appeal before tribunal. For this also we have a list of orders. A draft order is referred to in 144C in respect of a person in whose case variation arises on account of TP adjustment, or in case of a non-corporate, non-resident. Now, please note that they are talking about a draft order as referred to in 144C. They are not saying the final directions issued by the DRP, the order which is passed after final direction issued by the DRP. They are saying if the AO is passing an order, it's a draft order which is eligible or which is appealable before the dispute resolution panel. Against that draft order, you can file an petition before the DRC. But then there are certain additional conditions you need to satisfy. We'll see as we progress. It also covers the intimation orders under 143.1, 200 capital A, 206 CB. 143.1 is about summary assessment, where CPC does the automatic kind of process-driven adjustments. Some arithmetical error and apparent mistakes are rectified and demands are raised or refunds are issued. 200 days of processing of TDS TCS statement. So all those demands which are raised under these sections, these orders are subject to DRC. Order of assessment, reassessment in normal case, except the order passed pursuant of directions of DRP. So we know against the order passed by direction of DRP, we directly go to tribunal. We don't go to CIT appeal. So in the same fashion, that is excluded. A rectification under 154, which has the effect of enhancing the assessment or reducing the loss. So, in nutshell, assessee is an aggrieved party. Or any order made under 201 or 206. C, deeming a person as assessing default for failure to comply with the TDS or TCS provisions. What are the conditions apart from the specified? The conditions are the aggregate sum of variation which is proposed or made in such order doesn't exceed 10 lakh. One. Second, the return is being furnished by the assessee for the assessment year relevant to such order and total income as per the return doesn't exceed 50 lakh. So number one condition is return should have been filed, and second, the total income as per the return should not exceed 50 lakh. These conditions are cumulative, not optional. The third, the order in case of an assessee, it is not based on search, survey, or any information received under section 90 or 90A. If it is an order passed pursuant to search or survey or pursuant to information received from a foreign country under a double tax avoidance agreement treaty network, in those three situations, if the assessment order is passed, then you cannot approach the DRC. You have to follow the normal route, joint CIT appeal, or the dispute resolution panel as may be applicable. You can't approach it. So this is very important. What are the additional specified conditions? That additional specified conditions in relation to person means a person who fulfills the following. He should not be a person in respect of whom an order of detention has been made under the provisions of Conservation of Foreign Exchange and Prevention of Smuggling Activities Act. So under this particular act, if there is an order of detention passed, even if you are satisfying all the conditions, you have filed the return, your income is less than 50 lakh, variation is less than 10 lakh, still you're not eligible to appeal, find a petition before the DRC. DRC is basically for a quick resolution of an issue. So if any of this is pending, you can't go take a benefit of materiality, no, not available. If any prosecution is ongoing, like in respect of whom any prosecution of any offense punishable under the provisions of an IPC, Indian Penal Code, Unlawful Activities Act, Narcotic Drugs and Psychotropic Substance Act, Prohibition of Benami Transaction, Corruption Act, PMLA Act, if it has been instituted and he has been convicted of any offense punishable under any of these acts. So the important thing to note here is the prosecution has been instituted and he has been convicted of an offense. Then he is not able to approach the DRC. In respect of whom prosecution has been initiated even by an income tax authority for any offense punishable under this act or the IPC or for the purpose of enforcement of any civil liability under any law for the time being enforced. So what in essence the section says, okay, you need to see the conditions. These are the key conditions. These are the orders. Normal. Yeah, so these are the orders. Just a second. Ashokji, we'll need 10-15 minutes more. Is that okay? Okay, so I think somebody has put in a message in a chat room about time up. I don't know, from Board of Studies. All right. So these are the orders, and then you have to satisfy these additional condition. Variation is less than 10 lakh. The total income is less than 50 lakhs. Return has been filed, and the order is not pursuant to search, survey, or information under 1990A. If these conditions are satisfied, you have to see some additional condition. What are those? You're not being subjected to any detention under the Smuggling Act. You are not facing any prosecution proceeding under IPC or those specified acts, PMLA Act. And the Black Money Act. What is the time limit? in normal situation, 1 month from the date of receipt of order, and in case your appeal has already been filed and is pending before CIT appeal, in that case, within such time from the date of constitution of DRC as may be specified by the board. Now, once you file an application before DRC, what is the process? They are going to examine your application. They are going to provide you opportunity of being heard. If during examination it is going to be rejected, they'll ask you through a show cause notice. Rejection of application. In case there is a rejection of application, you can definitely have your alternate remedy of 246, 246 capital A and 144C. So DRP and CIT appeal is always available if there is a rejection by the DRC. If your application is accepted, then, and while at the same time you also filed an appeal before CIT or you filed an appeal before DRC, your matter is pending before the dispute resolution panel, in that case, you have to file an application of withdrawal, and that withdrawal application proof you have to submit to the DRP that you have this thing done. Procedure to be followed by the DRC. Once an application is admitted for disposal, the DRC will call for the record, they'll do the examination, they'll do all kinds of appellate procedures that are normal case of CIT appeal does. They'll also have got a power to seek report from the assessing officer. They can call for an additional information and assessing needs to comply with it. Once the proceedings are concluded before the DRP, after considering the material available on record, the authority, the DRC will give a directions to the assessing officer in relation to that specified, and that direction may be to make a modification to the variations, or it may also mean not to make a modification to the variation. Now, this is very important. The modifications to the variation in the specified order, which are not prejudicial to the interest of assessee, and decide for waiver of penalty and immunity, right? Not prejudicial to the interest of assessee. And second option, to not make any modification to the variation. However, it may decide to waive the penalty and grant immunity, even if there are any no modification suggested. And third, lastly, to not make any modification to the specified order or pass an order disposing of the application. Such order will be treated as an order not prejudicial to the interest of revenue. This is a clarificatory. Now, what is the time they are going to take in issuance of order? Within 6 months from the end of the month in which application is admitted, not filed. Once you file an application, it will go through screening. It will be admitted. After admission, they are going to take 6 months from the date of admission. From the end of the month in which application is admitted, they'll serve the copy to. Now the provisions are similar as DRP. They'll serve the copy to the assessing officer. He'll pass a modified order. Against that modified order, no appeal or reference shall lie, and serve the copy of modified order to the assessee as well. So this is all procedural, I think. Termination of dispute resolution proceedings. So if after application is admitted, if the assessee fails to cooperate, fails to furnish any information which is asked, or if the committee is satisfied that he has concealed any material to the proceeding, any material fact in relation to the proceeding or admission, or if he fails to pay the demand, then there will be a termination of the dispute resolution proceedings. So I think these are all procedural. I'm not discussing much in detail because we have already discussed in the interest of time. And faceless, lastly, faceless scheme for dispute resolution. So like we have seen for assessment, we have already a specific section. We have notification where all assessment proceedings except certain cases where the such matter is there, where the transfer pricing assessment, where physical assessment is ongoing. All the matters are now happening under the faceless regime. Appeals are also under the faceless regime, subject to certain exceptions. So everywhere you will find a provision where the government has been authorizing the board to introduce a faceless scheme. So likewise for dispute resolution matter also, faceless scheme has been notified. So that's all for today. And you are requested that you go through the assignment, which is the questions, the revision test papers for chapters which we discussed in the last 1 week: assessment procedure, appeal proceedings, miscellaneous section, dispute resolution committee, and of course for the sessions which are going to come. So these are the questions which you are supposed to do it by yourself, not only for chapter 17 but also for chapter 18. So I've not discussed all the questions and judgments consciously because each provision has been discussed in great detail. So it is good that you instantly, immediately, or maybe within a day or two, you go through this, so that once you do it yourself, you are going to easily memorize it. If you skip it now, you're not going to do it later. So good night to everyone. Have a nice time and all the best. Ashokji, we can conclude. Ashokji? Okay, thank you. मैम है क्या सेशन में? हाँ ठीक है चलेगा, चलो कंक्लूड कर लेते हैं. ऑल राइट, थैंक यू. Thank you. Bye bye.